save premiums or to increase flexibility with the existing contract. We can replace the policy with a much more efficient contract. We can look at premium holidays where we can stop paying premiums for a period of time. And this is only available to be done on certain types of contracts. There are other like guaranteed contracts where you can actually cause more damage by doing a premium holiday than good. We can do a reduction in death benefit, a reduced paid up policy. We can surrender the policy for cash value, always have that option. Cost basis recovery is another big one. We've been doing that quite a bit lately, where the clients maybe paid $1 million into the policy, only has a couple $100,000 of cash value, so they've got a loss in that contract that they can't take because it's a life insurance loss. Well, we can 1035 that $200,000 into an annuity, and now the basis follows that 1035 exchange because you can go life to annuity, and now all the growth from 200,000 to $1 million is tax-free because you're just basically growing it back to the basis. Or you can add more money on top of it and have that grow, because it's going to take a long time for 200,000 to grow to $1 million. We have gifts to charity, and then last but not least is life settlements. And with life settlements, we discovered Abacus life settlements through our relationship with John Kramer, one of our partners in San Diego, California. And we had always worked with brokers, and Scott had told me over and over again, there's a big difference between a broker and what we are. And I finally opened my ears up after John had convinced me to do so. So I'll let Scott tell you a little bit about Abacus and really start into the meat of the presentation. We're going to unmute you in a second here, Scott.
Thank you. Sorry about that. Good morning, everybody, and thank you, Ryan. So I guess before we kick off, I know a lot of folks may know who we are. Abacus Life is one of the larger direct buyers in the market. The market has really experienced a lot of compression in the last couple of years, where the top 4 or 5 buyers are purchasing most of the policy flow out there, just not in the amount of policies purchased, but also the capital deployed. Our company is backed by one of the largest private equity firms in the world, and we bring a different approach to the market, which we'll kind of touch on today. We think of ourselves as your partner when it comes to information, transparency, and this slide kind of speaks to where the market is today. I mean, as you can see, the market has continued to expand in the last 4 years, not just in the number of policies purchased, but also the amount of death benefit purchased and the amount of capital deployed. It's important to note that the 2019 numbers won't come out until June of this year, but from our internal data, we are expecting to see a very similar growth in terms of, overall 10% increase a year. And we're going to go through a couple things today. We're going to talk about the capital markets and a quick industry update. We'll talk about some regulatory and legislative support for our industry. We'll cover some pricing and underwriting trends, and then we'll also kind of really get into the meat of today's discussion, and that's how we approach policy evaluations and audits. One of the most obvious reasons for this growth is an aging population, and we've all seen the statistics. But it's worth noting and reminding ourselves, because this slide and the next slide, I think, speak of the reason why we should be talking about life settlements. 10,000 people turn 65 a day. North America is the second oldest region in the world. And this aging trend is going to continue. The next slide, I think, really speaks to the importance of this aging population. And that's the point where clients are experiencing some of their biggest changes in their lives, whether it's growing families or retirement concerns or even healthcare needs. But 50 million plus seniors need our help when it comes to insurance and financial planning. This, for me, the 65 to 84 bracket really is what I call the sweet spot for the advisors on our call today. when it comes to long-term care and life insurance and replacement strategies. And guess what? One of them is also life settlements. But we haven't done a very good job in explaining to our clients that their life insurance really is personal property and that potentially has a market value, and it should be realized, whether it be because of a sale or because of just a valuation, especially when our clients are reaching their golden years. We did an internal survey that Abacus conducted. Only 1% of Americans knew their policy had a market value above their current surrender value. $143 billion are forfeited back to the insurance companies every single year. We also know that 90% of seniors would have considered a life settlement if they knew the option existed. And as the prior slides showed, 76 million Americans will be at the retirement age of 2020. That's a big, big market.
And Scott, if I can add something here, the biggest thing is that with that 143 billion of policies that are surrendered, as advisors, especially the advisors that are not financial services professionals, we just don't hear about it. We meet with our client and then we say, do you still have that contract or that policy? And they say, no, I surrendered it last year. What we want to do is make sure that we give you enough information so you can proactively talk to your clients about what's going on, so we can get out in front of those poor decisions or those knee-jerk decisions just to cancel a contract. Because when you go through the case study, you'll see there are many times where the market value of that policy far exceeds it. It's just a matter of education. That 1% on this current slide really speaks to the fact that just most people do not know or do not understand how that marketplace even works or that it exists.
Sure. So who qualifies for a settlement? Obviously, we know it's aging seniors, but the policy types haven't changed a lot. It's usually the UL, GUL, VUL type products, although we only see about 10% of our business is VULs. Term and term conversions, we'll have a case study later on in the presentation that talks about term conversions. That's such an important part of the discussion because so much term policy just lapses every year. No one thinks about the option of, does this term policy have value for the conversion? Whole life policies qualify. Some group coverage also qualifies. For the insureds, anyone 78 and older, if they're healthy, will almost always qualify for a settlement. If younger, we need more medical impairments. And we also service folks that have critical and terminal illnesses. Although, we often hear that life insurance and life settlements are uncorrelated. And for the most part, that's true. But credit markets have significant correlation. It's based on, liquidity issues. Lack of liquidity can, create higher volatility. And although our industry doesn't have quite the peaks and valleys as other industries do or other markets do, the next slide does, suggest that there is some stabilization in how we approach pricing. Our rate pricing is much smoother than other credit and global markets. But pricing can be affected by consumer behavior. Right now we're in a big economic turn down. Believe me, our phones are ringing and wondering, is there a marketplace? I will tell you, there is a marketplace. We have currently, I think between our capital source and our main capital partners, about $1 billion of just dry powder to buy policies. And obviously, the pricing trends are going to flow. Right now, we are really pricing at historical low levels. We are anticipating pricing to go up in terms of an IRR, which will make pricing a little more conservative. But these won't be knee-jerk things. The smoothness of our rate curve is much different than normal markets. But in spite of all this, we have a very well-regulated industry. 90% of our population benefits from some type of regulation. And although there may be varying degrees of regulation as it relates to disclosures or pricing standards or waiting periods, one thing is constant. And despite of any pricing or underwriting adjustments, there will always be a secondary market. In fact, some states now require insurance carriers to inform policy owners that they should consult with a licensed insurance advisor to learn more about alternatives opposed to letting a policy lapse. There are currently 8 states that have that, and there's 2 more pending. One of the hallmark parts of our regulation is mentioned in this slide, and that's really the benefit of everyone on the call today, because not many of us realize that as insurance advisors, we have the ability to work with some of the direct capital market participants through your broker producer authority. We'll go through this stuff really briefly the next few slides, but the Income Model Act defines a life insurance producer as a broker. Broker, someone who represents their client in a life settlement transaction. California, Florida, Texas all support this definition. There's other things in our industry that are very supportive in terms of a regulatory aspect. The next slide really talks about this compression I mentioned earlier. We've been tracking our sources of origination since 2016. What's interesting is because of the producer authority, our agent direct business has almost doubled. However, the client direct business has almost doubled as well. There's a reason for this. We've all seen the commercials on TV. There's a lot of capital allocated to buy policies. And as we also mentioned, there's just a lack of a consumer awareness. We need to be in front of our customers more than ever and be aware of their needs before someone else will, because they are seeing the commercials on TV. They are letting policies lapse. This trend we think is going to continue, where more advisors are accessing the marketplace, their partners like WealthPoint, and more consumers are needing our help more than ever. In addition to the market being very highly regulated, there are a number of, I think, key things that really give our industry a big endorsement. We just put on the House floor this year a new bill called the Senior Health Planning Account Act. This will be a big boost in our industry. It helps seniors plan and pay for their healthcare costs. Effectively, if you sell your policy and use the proceeds for healthcare, long-term care, they're tax-free. Even the NAIC recommends that settlements are a suitable solution for funding long-term care. Interesting enough, even the recent tax bill, the next slide will show us that there was a component that speaks to our marketplace as it relates to taxes. For years, we thought your basis was premiums paid minus COIs, but they redefined that the basis are the floor premiums paid, a much clearer definition of how we account for taxes. Speaking of taxes, there will be reporting. 1099s will be filed by both the insurance company and the settlement company.
So Scott, can you go into detail as to exactly how that is calculated now? And then I would like to talk about something I was muted and couldn't make a comment on a couple of slides back. So I just, we don't need to go back to it, Michael, but would like to make a comment. So it's just, how is that taxation now?
So the sale price minus your basis, which now is defined as premiums paid, would be taxed as ordinary income.
Not
in a lot of cases, not capital gains, no. And a lot of times the premiums paid are more than the settlement, especially if you have an older policy. So in those cases, the settlement would be tax-free. There's also the old viatical law on the books. If a client has a terminal illness, those proceeds are tax-free regardless of age.
Gotcha. And when he was talking about origination and agent origination and the Brand X life settlement provider that we see commercials on TV, Coventry is the company. I'm sure we've all seen them. But you look at the industry statistics, and I've seen in some of the publications, industry publications, where their average purchase price as a percentage of face amount is 16% versus the rest of the industry is in the low 20s. And so that direct to consumer model is great, but it's usually great for the investor or the buyer because you've got a very uneducated consumer and you can buy the policy at a lower cost. So having somebody represent you in the marketplace can and will result in a much higher price than going just direct to the funder. So go ahead, Scott.
No, that's right. So this is kind of, I think, why we're all kind of here today, to talk about how life settlements in the secondary market can help us in our practice. We are all doing more and more of these policy evaluations and audits. It's become, as Ryan mentioned, kind of the cornerstone of how WealthPoint approaches as part of their overall planning. And there's a reason why we all should be conducting these policy reviews. The last 2 years, we've had some of the biggest carriers announce cost of insurance increases. Our clients are living longer. There's policy maturity risk on some of the older policies. We've had clients who've had health changes. We've had clients who are having difficulty funding the policies. So it's more important than ever to do some type of policy evaluation or have access to a team that can help you review policies on a regular basis. And that's kind of where we come in. But there was always a kind of an issue with how do you approach evaluation. The next slide will kind of demonstrate this issue. What we call underwriting has been the challenge. You'd have to order medical records, which takes time and takes money. Order a life expectancy, that takes time, that takes money. When really all we want to know is how much is my client's policy worth as early in the process as possible, so we can properly do our planning. And we have a solution for that.
And that's probably one of the biggest tools and benefits that we've seen in our partnership with Abacus is the ability to be a liaison and not just do all the financial analysis that you'll see regarding the decision making on whether or not to do a life settlement but it was also to take all the data that Scott's going to talk about and be able to give you or your client a pretty spot on initial valuation, so we can decide whether or not this is the route that we want to go down. Rather than going through a full-blown underwriting process and get people pregnant with a deal, we can have somebody go through and with just filling out a simple health questionnaire that you see on the screen, just a brief summary of their health history, medications taken, and we understand what their impairments are. We can get pretty darn close, because as Scott will tell you, it's not rocket science. It's how long is the client going to live as far as their life expectancy, which is just a coin flip. What's the carrying cost of that investment for the investor? So how much do I have to pay in premiums? And what's the payoff? What's the total death benefit? And then they back into what rate of return they're trying to achieve. It's pretty simple. And the other thing is you got to realize that they pay tax on that death benefit. So when you're trying to figure out whether or not they are going to achieve a too high of a rate of return, you have to discount it by the fact that they are going to have to pay some income tax. But Scott, go ahead.
Yeah, so the WealthPoint questionnaire really is a great place to start. It allows us to capture the client's main medical impairments. What we've done, and with this type of questionnaire, it allows us to start our pre-pricing without the need to buy APSs or order life expectancies. And this is how we did it. So over the years, we've collected thousands and thousands of life expectancies. And we broke them apart by age, gender, and their main impairment. Pretty impressive chart when you consider how detailed someone's medical records can be. But with a simple questionnaire, it allows us to profile the case really using thousands of data points that we've already collected. We can also do prescription drug searches, which allows us to do a risk identifier score. But the bottom line is, with a WealthPoint questionnaire, we can determine a life expectancy without the need for costly and delayed APSs. The next slide shows that output. So this is an example of a male age 80, primary impairment of CAD. So it's a cardiac issue. And this shows the multiple life expectancies that we collected for this one particular profile. I mean, with just knowing the client's age, gender, and their primary impairment, we can benchmark the LE across thousands of previously generated LEs. It makes our crystal ball so much smarter and quicker. So
So,
so I'm sorry.
Scott,
So what?
we had a question real quick. Just to clarify, in terms of taxation, there was a question around when is it capital gain? It's going to be capital gain over and above basis, unless the only exception is if the cash value gain is in excess of the basis in the policy before the sale. And so it's generally a capital gain to the client. Is that not correct?
I think the new code has it as ordinary income. There is a capital gain component. I think if there's the account value, they just changed. Like I mentioned, it's a new revenue ruling that just came out. I'll be happy to circulate that back to you, Ryan. We have a couple legal letters that kind of talk about it. But I'll forward that back to the group that you can recirculate to all the folks who joined today.
Perfect. Sorry for the interruption.
No, it's fine. That's a great question, and I hate to sound uninformed, but we always try not to get too deep into the tax dive. It can be complicated. But where do you start from here? The pre-pricing. I think we do so much pre-pricing these days, and the pre-pricing then kind of goes to what we call then the policy evaluation, which then kind of goes into the whole kind of policy audit role that we'll talk about later. But the steps are simple. With a medical questionnaire and a current in-force illustration, we can deliver pricing within a day, sometimes a couple hours. That pricing is going to be extremely close to the final end pricing once we decide to do a deep dive and grab medical records. If the pre-pricing is acceptable, then it's time to go buy the records, get the LE. But the pre-pricing component, I think, is so important to start the conversation with the client. Is this is how much our policy is worth. Once we get the life expectancy reports in, and we usually are buying 2 or 3 of them at a time, our formal evaluation will be presented within 1 to 2 days. This whole process takes probably less than 3 weeks. We've been able to shrink the process down to just about 5 to 7 days of getting a life expectancy, maybe 7 to 10 if the LE companies are busy, but then we can deliver pricing within a few days after that. If we had APSs in our hands today, we would be talking about really formal pricing within 2 weeks. This is very similar to what WealthPoint does in terms of their initial presentation. They'll get informal quotes from carriers. And then, Ryan, because you were kind of informed me on how that process works, how this is similar to how you approach life insurance quotes as well.
Yeah, whenever we go through the process of evaluating, what the need is for insurance, we're always doing field underwriting to get an estimate of what somebody's underwriting rating may come back at, just based on, again, it's simple. It's medications and current medical impairments and height and weight and smoker, non-smoker. What we don't want to do is, like most people, is to come out with a super preferred quote, and then all of a sudden the client comes back standard and it's 50 to 60% more. We don't want that bait and switch type of approach, and that's why this really resonated with us. Rather than having some big quote and to lure somebody into the settlement process, we can actually go in with relevant data, say, what are your impairments? We can look at those impairments and see how the life expectancy companies, how those studies have come back, because we've got so many data points that we can point back to. We can estimate what the life expectancy is going to be. Let's say it's 100 months, and then very, very easily back into a pretty tight range of potential pricing. At that point, though, we want to go through the full underwriting process and create a bidding process for that policy, of which we assist with along with Abacus. Go ahead, Scott.
Also, I think important to note, there's never a charge for any of this at all. The money and time that we spent building out our pre-pricing tool allows us to eliminate the need to go into these things blindly. So if we're smart about the medical questionnaire and we're gathering as much information as we can, and we have a current in-force illustration, our pre-pricing is going to give us a great indication of how the price or how the case will look down the road. And it gives us all confidence that when we do decide to go for the formal quote, then everyone is kind of bought into it. But as I just want to make sure that there's never a cost for any of the life expectancies or the APSs when working with WealthPoint or Abacus. This has become a interesting discussion recently, is how we're working in this new world. And it really affects how we approach our clients. I've had great conversations with advisors on how you are approaching clients in this remote world we live in. We looked at our industry, because our industry does have a very hands-on contract component to when we buy a policy. So we're looking at ways to do DocuSign and e-signatures. In certain states, we can use remote online notarization. We're waiving certain notary requirements. We're also introducing third-party identity affidavits where someone will, like an attorney will state, yes, I know this person. We're also offering a retained death benefit component to our settlements. If a client has a concern about COVID or any illness that may result in a very unexpected passing away, we can offer a 12 to 18 month vanishing retained death benefit, almost like you're buying a term rider in some degree. So I just want to kind of briefly just talk about this. We are looking at this and how we can work with our clients remotely, and we are offering some benefit to the sale above the normal cash price. And I think this is where I kind of pass the mic back to you, Ryan.
I think that the COVID thing, because it has come up. I just had a national study group call last week, and that was one of the things that they said clients were worried about. I don't want to explore doing a settlement right now, even though I really need to look at it, because what if something happens and I can contract COVID-19 and I end up perishing from it? And having that retained death benefit, or it's a gradually reduced participation in the death benefit, is it not, Scott?
We can do it a couple ways. We've done them where we would, say it's a cash offer of $500,000 on a 10-year life expectancy. We would on a death benefit of say
$2 million.
$2 million. We would roll in maybe another $500,000. Or $750 retained death benefit in those first 12 months. And I don't mean to sound sensitive, but certainly if there was a passing in the first 12 to 18 months, I think everyone's interest is aligned in terms of the performance for the fund, in terms of a payout and a return, but also the more important, the client. The client feels like they also participated in the unexpected passing as well. So we can also do graded RDB, where we can, an example of that would be if my underwriting has a client at 5 years, but the family thinks that the grandmother has a 2-year life expectancy, we can do a graded RDB on top of the cash offer, where maybe in the first year there's a 60% payout, but in year 2 it goes to a 50%, and it starts to kind of just decrease, as you mentioned, to what we had projected the life expectancy was based on the cash offer. So not many people offer retained death benefit. I think it's an important part of the conversation, because it does address everyone's concerns about an early passing, leaving money on the table, this whole seller's remorse issue. So we can factor in RDB in almost any type of settlement.
So let me remind everybody that, again, the chat function, which is in the bottom center of your Zoom screen, is available, and please feel free to ask any questions. We're going to go through a case study now. Michael, if you'll forward. This is a client of ours that was referred by a local wealth management firm. And the clients, we had a husband that was age 86, and his wife had already predeceased him, and they had 2 survivorship life insurance policies held in an irrevocable trust. each with a death benefit of $2.5 million. So 5 million total. And the client had done a lot of asset shifting, had shifted a lot of his assets to the next generation, had retained enough capital for their own financial security, but it was only enough to cover that. So they had done a really good job of planning with the family group from an estate planning perspective. The client was living a pretty healthy lifestyle, 30, 35 grand a month net after tax. But the amount of money that he had left in his marketable securities, his cash and securities, was just enough to cover it. You would think, okay, well then shouldn't the kids be willing to take on the responsibility of that $234,000 premium? Well, they were in their 50s, late 40s and early 50s, some in their late 50s, and the kids had grown accustomed to the cash flow that was being spun off by these assets that he had transferred. So they couldn't afford the premium. And so we got a call to help with the surrendering of that policy. And to surrender that policy, we would only get $598,000, I believe it was. We'll see if I'm right. I'm guessing on the next slide. But the primary objective is just to eliminate the expense for the family group and maximize the rate of return or net to heirs. And so before we go through with it, we want to find out, what are the options that the family has, assuming that they're not going to be able to pay any future premiums. And so the first one is you can always keep both policies. Well, that only really works if the policies are going to be funded with whatever previous premium outlay has been put into the policies. They're going to be funded well into a point where they can potentially collect the death claim. So they can always keep the two policies. They could surrender both policies and invest the proceeds. And the investment rate of return that they were looking at was a 4% net after tax in expense rate of return, because it was going to be invested not for the father at age 86. It was in the trust for the benefit of the kids. So we had a little longer time horizon. We could keep both the policies and reduce the face amount, so do a reduce paid up. So these are all things that we can do without settling the policy. And so we want to look at those things, because inherently, when you look at a life settlement, you have to look at it through the lens of the investor that's buying the policy. If it's a good enough investment for them, it might be a good enough investment for the family group. And we've got to be able to educate the family group and say, this is an asset that you're giving up that's generating a very nice rate of return for an outside third party. The fourth option that we looked at was selling one policy and then using the proceeds to pay the premiums on the remaining policy. So one policy had a little bit more settlement value than the other. We could sell it and then fund the second policy and have that one go out, and we would collect at least half of that death benefit of $2.5 million, but it would only be based on how long that policy would stay in force. And then the last would be sell both of the policies and invest the proceeds. And the question really comes up is, for us, it's a numbers game. And so if we go to the next slide, we've really, our actual analysis was far greater than this, but it really comes down to, we try to boil things down into a picture or graph. If we look at the, Michael, if you can point out the 50% probability of death, which is where 50% of the people in a specific age and health demographic are going to presume to be have perished, and that would be at his age 92 and a half. And so at 92 and a half, 50% of the people will have passed. 88.6, or almost 90% of the people will have died by age 98. Dad had some significant health impairments as they were looking at, the kids were evaluating this, but he also walked many miles a day. I forget how many, I don't want to misquote it, but it was five plus miles a day at age 86, ate near 100% clean, just led one of the healthiest lifestyles that we've ever witnessed out of an elderly gentleman. Very healthy, very active, and was just a pretty impressive human being. And so when we looked at these things, the kids themselves said, we think Dad's going to go long. When we say go long, that's the tail risk or the liability that the settlement companies, they worry about what happens if people live well beyond life expectancy. What's our exposure? Well, the kids were looking at it. Dad's going to be on the long side or the right side of this mortality curve, or on the downslope, not on the left side. He's not going to die early. So the first option, keeping both the policies, they would only stay. One would stay in force for. They would stay in force for a total of one would stay in force for 2 years, the other one 3 years, and so we would end up with $2.5 million of death benefit for 1 year, and by age 91, we would have zero death benefit. So that really wasn't an option because there's no way in heck they were going to give up the $598,000 today that they could get. The blue line represents the just surrendering it and investing the proceeds. So what would that grow to? The green line represents doing a reduced paid up. So we could only reduce the policies a certain amount, but we could reduce them down to about $1.7 million in death benefit. But then slightly after life expectancy, we would have these policies crash and burn. The yellow line represents selling one of the policies. So if we sold one of the policies, we could keep the other $2.5 million policy in force. And so obviously this is greater than $2.5 million in the first year because we gradually spend that cash down and are able to fund the policy all the way out until his about age 95, and then all of a sudden they've got zero. So they would have more than $2.5 million all the way up till that age 95, but then if he didn't die before then, they would get zero. And they felt like that was too big of a risk. And then the last option was to sell both policies and invest the proceeds. And they just felt like that had the least risk. But we can see that if they would have sold one and funded the other, they would have had far greater, the difference between that yellow line and the red line. They would have had a bigger outcome for the family group. But what we wanted to do was just make sure that we educated them on all the options that were available to them and make sure that they were making the decision that was best for them and their family group, and not just motivate the sale of a life settlement or to promote the life settlement transaction itself. The next slide, it really talks about compensation. Although it's a very regulated industry, as Scott said, in comparison to 15 years ago when I first started doing life settlements, it's still pretty widely unregulated in terms of certain things. And there's a pretty wide range of compensation that can be had. And so the traditional calculations for compensation on a life settlement is a third of the value created. So if I used easy math, if a policy had $100,000 and they sold the policy and the client got $1 million, there would be $900,000 of value created. So an agent could take up to a third of that $900,000 or $300,000 in compensation, which means that they could then the family would only net $700,000. The other percentage is between 20 and 30% of gross offer. We err on the lower side of that, not to exceed 6% of face amount. So 20% of gross offer is a metric, or 30% of gross offer, not to exceed 6% of face amount. And then 6% of face amount is another metric that's used for compensation calculation. And so the average compensation for this sale is, somewhere in the $378,000 range. We discounted it on ours because there was a lot of financial analysis done, a lot of meetings with the family group, and there was a 37% discount, which added 9% to the value received by the trust or the family group. So our total fee for this was $240,000. Our compensation is generally discounted between 25 and 75% of the industry average. And again, that just really depends on age, face amount, and the complexity of the case. What's important here, though, is that Scott had come to us first with what's referred to as a papers-only offer. And we had a papers-only offer, and I'll let Scott describe what that is, for about $1.1 million. And that's something that is available, but sometimes you get a great offer on a papers only offer. Sometimes you're going to get a much better offer if you go to a fully underwritten case. And what that ends up doing is if clients are being promoted a papers only offer and you've not explored the ability to go out and have it fully underwritten, you may be leaving a tremendous amount of money on the table. But some agents will gravitate toward that because it's very, very quick turnaround. You can probably have a sale done in a matter of a few weeks as opposed to a few months. And so by taking the extra time and really going out and shopping this, we went from $1,000,001 or $1,150,000 to $1,940,000 in gross value. And that's the one thing that you want to know as an advisor is what's the gross offer before any compensation is paid. And that compensation can be paid to either the broker or the brokerage company, not like Scott. Scott, they're a direct buyer. And I'll let him talk to that a little bit because I think it's an important point, or the agent that's working with that brokerage company. And so we've chosen to go to Scott and Abacus because they buy direct on behalf of 5 of the largest funds, life settlement funds in the country. And they're totally transparent with the whole process of pricing and decision making. And so if you're not able to really go out and fully shop this and you're only looking at trying to make a quick buck as an agent, clients can be left with a lot less money. In this case, it was about $800,000 less money to the family group as a result of not going through the process. Scott?
Yeah, this case is when we first started working with WealthPoint, and I was really impressed with just the way that Ryan and his team approached this type of analysis, and not many firms do this. At that same time, we started also to become really transparent on how we approached our clients and our partners like Ryan, where on this case, we were ordering more and more life expectancies, trying to benchmark the best blend we could in terms of underwriting. We actually showed Ryan and his team our pricing model, showed them our premium stream. Before this call, I was on a call with an advisor and their client directly, and I emailed them our premium stream and the life expectancies. It's a level of transparency that not many settlement companies will offer. But as to Ryan's point, it's important that we're all looking at the same information. I think from the buyer's perspective, from the advisor's perspective, and also the client. The client should know everything that I know about the decision-making to buy the policy. So this was a great case in terms of just how Ryan's efforts in terms of his analysis and my efforts really matched each other in terms of the right decision-making to sell or not sell. As a direct buyer, we always are asked, is there any risk of working with a direct buyer? Our approach is, any direct buyer should be transparent as possible in the transaction. We are going to show you our underwriting. We're going to show you the math behind the math. And that's just how we're wired. And I think it makes the decision-making process easier. We'll do a couple quick case studies, but, we'll do more pre-pricing than we do buying. And so what happens is on this case example that Ryan just mentioned, there was a lot of pre-pricing and pre-analysis on their end and our end. The decision-making wasn't done until after we all did our valuations and our pre-pricing. So the pre-pricing is very important. I know we're kind of strapped on time now, but just go through a couple case examples and explain different types of policies we can buy. We mentioned term policies. About 1/10 of our book will be term conversions. The benefit there is that the advisor and the agent are involved on the conversion. But this is an example of a young man or young male with some impairments. This would have been left on the table and not converted if there wasn't a secondary market. Term policies aren't typically big sales. It's really just kind of found money, but we do offer term conversions. The next slide talks about a critical illness. There's a lot of folks who are coping with some type of end-stage illness, whether it be cancers or Alzheimer's or ALS. one of the things we do on our critical illness cases, like this one, we offer the retained death benefit. Well, actually, this one, they had an ADB that they paid. We paid back the ADB, which is accelerated death benefit. But we do work with folks who are coping with short life expectancies. The next case study is where we get creative on retained death benefit. This was an example of a 76-year-old male with a 12-year life expectancy. Second to die, but one had deceased. We offered a couple options for them. Either do a $660,000 all cash offer, or a $60,000 cash offer with $1.5 million of retained death benefit, or $310,000 cash up front with $1 million retained death benefit. So there's a number of ways to structure these deals, whether it be cash and RDB. I think we'll do one more slide, Ryan, one more case example.
Yeah, and then Michael would like to talk about the tax issue. We want to make sure that we get that cleared up before.
Okay. This is an example of an older female, a shorter life expectancy, where we offered a cash offer or cash with RDB for 2 years in the event the underwriting was wrong and we got it. If the client died early, we were offering a 2-year RDB as part of the overall offer. And I can go on, Ryan, or I can hit the pause button now.
Do you have one more?
I've got one more.
Okay. Nope, you don't.
Nope, that's it. Okay.
So, Michael, I'd like to turn it over to you to answer the question with regards to taxation on policies. Even though Scott is reluctant to give any kind of tax guidance, we'll hang it out there and at least explain our understanding. But as always, we encourage clients to rely on their own income tax advisors for taxation types of questions, but we can at least provide some guidance. Michael?
Sure. Yeah. So basically, there's different tiers that you look at when you sell a policy. Any value received up to the basis or the premiums paid in, the cost basis of the policy, is going to be tax-free. Any amount that is received that is above the basis but less than the cash surrender value is going to be treated as ordinary income. And then any amount that is above the cash surrender value is going to be treated as capital gains. So it does require a little bit of work and analysis to kind of factor in what is the tax treatment, what's the overall gain, and then what portion of that gain is going to be ordinary income, and what portion of that gain is going to be treated as capital gains. That's actually a change from the way that the tax code used to read before the 2017 Tax Act. Prior to that, it was always ordinary income. And then in addition to that, there was actually a favorable treatment or a new regulation that came out with the tax code and the Tax Act in 2017. Prior to that, cost basis, if you sold your insurance policy, was had to be reduced by the amount of cost of insurance charges that you paid in. In other words, if your basis was, say, $50,000, but you had paid in $10,000 for cost of insurance charges, your adjusted basis when you sold the policy was $40,000, which resulted in a larger taxable income situation. Now, as a result of the tax change and the Tax Act in 2017, there is no reduction for the amount of cost of insurance charges that you've paid. So your basis is, that whatever you've paid into the policy less whatever you've taken out in the form of withdrawals. So
the bottom line is we have a calculator that we can run it through very easily and be able to determine what portion of the policy sale proceeds will be taxed in what way. The one thing that Scott said a little earlier, which I think we can close with, and if there are any questions whatsoever, please do not hesitate to put them in the chat function. But even if a client is not considering, it's always good to understand what the value of a policy is. But even more importantly, even if it's not considering a life settlement, it's considering a transfer of an asset, getting a proper valuation of a life insurance contract is really important, just for gift tax purposes, or for transfer from a corporation or to a corporation. Anytime you're moving a policy, it's important to know the value of that policy. So we are here for you to help your client if they're just wondering, what's my policy worth? It could generate additional liquidity for them. It could be used potentially as a way to substitute assets in a grantor trust. So if a policy has a really, really high value, you may be able to substitute assets and get assets out of the taxable estate. There are lots and lots of tools to utilize this for, but our primary function, because of the economic uncertainty that we're in right now, is to talk about how settlements work if you're looking to actually sell the policy. So what's most important, and what we hope that you've taken away from this, is that this is a very fluid marketplace, but it's also a marketplace that requires a lot of transparency, both for the advisor and the client, to really make an informed and adequate decision regarding their financial affairs. The second thing is that compensation, as you can see in my example, if there's $1 million gross offer and 100,000 of pre-existing cash value, the client could receive as little as 700,000 and as much as $1 million if there were no commission. And so we just look at, in that case, we might be in the $100,000 range. Well, if you've got $200,000 more net to the client, that can result in much more value being delivered to your client, as opposed to not having full transparency into the gross and net offer that's been experienced. The last thing is, by having adequate representation in the life settlement marketplace, you can make sure that that gross offer is as high as it possibly can be. And while we would consider Scott and Abacus as a partner, we represent the client. And so we're pushing on him, and because they're trying to buy at the lowest possible price. So we cannot be in bed with Scott, even though we view him as a partner. Scott is doing the best that he can to buy on behalf of the funders. And Scott, if you can talk about what that means and the difference between a broker and what you guys do and what your business model is before we wrap up, I think that would be very, very helpful.
Sure. So the in the pure definition of a broker, they're going to access funders and buyers like Abacus. That process is a little bit laborious. So there's a long waiting period to get the final offer. There's a lot of uncertainty of what's happening in the process. Just a lack of transparency. The direct buyer like Abacus, we're actually buying on behalf of the major fund managers who buy through licensed providers like Abacus. We have certain fund managers that like GUL products better than other ones. We have certain fund managers that specialize in shorter life expectancies. Our job is to get the best offer for the client, but at the same time balancing the best underwriting and returns for the fund managers. It's a bit of somewhere between an art and a science. It is about meeting expectations for the seller, being transparent to the advisor in terms of how we see longevity risk, where we see tail risk. But we're going to have access to most of the main buyers in the marketplace, whether it be our main private equity firm or some of the other large capital firms that buy through a group like an Abacus. There really isn't a lot of policies in the marketplace that are purchased that we can't offer on. So working with Abacus, you're going to at least get the ability to measure evaluation, measure pricing, and do it in a much cleaner, transparent way. And as you said earlier, Ryan, we give you the gross offer. There's no cost at all associated. There's no fees that we charge. You get the gross offer.
So anytime that your client is contemplating making a major change or any change to a permanent life insurance portfolio, it's important that you look at all of the options and look at both the intended and more importantly, the unintended consequences. So we're always here as a resource for our advisor partners, and welcome a phone call. We're happy to, as a professional courtesy, be able to go through and just really evaluate and help you see, could there be a potential better outcome just based on a preliminary fact pattern. So please do not hesitate to engage us. If clients are looking at life settlements, we would love to be able to help the client achieve the best potential outcome that they can. And more importantly, we've had several situations where they were looking at a life settlement and they had the cash flow to fund the policy, and it just made way more sense. And that's one thing that we've come to respect about Scott. He said, this is far too good of an investment. It's a great investment for us, but it's far too good of an investment for the family group to pass on. So we're not afraid to make that recommendation as well. So again, it really just comes down to what's in the best interest of the client. So I want to thank everybody for coming on board. Michael's going to close with some closing housekeeping items, and we hope that you have a great finish to your week. Michael?
Yeah, thanks, Ryan. Again, just a quick reminder, we are offering CE. So if you would like CE, please send an email to myself and indicate what type of CE applies to you. And then we're also going to be sending out a survey, and we would love to hear your feedback on the presentation. I know we're a little bit over time. We did have one question that got submitted. So Scott and Ryan, if you can just take that real quick. It was from Kevin Rademacher. What is the minimum death benefit that you would want to review? And then is there a preference or a sweet spot that you prefer to analyze, either based on policy type or insurance company?
Scott, you want to take that?
Yep. We'll look at policies as low as $100,000. A policy that small, the life expectancy needs to be probably under 10 years. In terms of doing evaluation, we can value really any policy above that $100,000 threshold if we know the client's date of birth and having the WealthPoint questionnaire. And in terms of carrier types, we'll look at almost any one of them. You know, some of the carriers who are no longer issuing policies, like Voya, there may be a hesitation on a strong valuation because of just servicing that carrier. But we'll look at almost any carrier, but be cautious as the ones who are currently raising COIs, though.
Did we hit all points of that question, Michael, or?
Yeah, I think the only other thing was just if there's a preference on product type or carrier, which it doesn't sound like that there is. So.
I would say that and Scott, you can correct me if I'm wrong, but guaranteed universal life contracts are the preferred option from funders, just because of the fact that they don't have to worry about cost of insurance increases.
Yep. GULs, current assumption products. As I mentioned earlier, really any type of current assumption GUL product is our preference. We'll look at term, we'll look at some whole life.
But just about any product, but it's really the fixed rate products are the most attractive.
Correct.
Fixed or guaranteed. The other products are the variable or indexed universal life, which has been sold quite a bit in the last 10 or 15 years. Those are also available, but they're not going to look at it at high rates of return or rate of return projections. They'll be looking at more conservative rate of return projections when calculating the value. So is that it, Michael?
Yep.
Okay. Thank you again, everybody. And we hope you enjoyed this and found it both enjoyable and informative. And thank you, Scott, for your time. We really appreciate your help and your time in presenting to the group.
Thank you, Ryan.